Hi. Working in Silicon Valley has really afforded us the opportunity to work with clients and help them in their transition from private company to public company status in terms of their tax function. And we've, over the years, established a 7-step process that has really been successful in terms of helping our clients with this transition. We were, in fact, published in the Journal of Accountancy's October 2011 edition with a related article entitled Act Public Before Going Public. And that title really exudes our approach with respect to assisting companies from their transition from private company to public company status in terms of their tax function, from the perspective that we really believe that a company needs to act public well in advance of going public from the tax perspective in order to assure a successful, a smooth IPO with respect to their tax function. Well in advance, at least a year in advance, a company needs to start prepping their tax function for their transition to public status. So as far as that 7-step approach goes, a 7-step process that we apply, the very first step is to basically institute an independent and a proficient tax team. And it's very important that a private company step back and evaluate their tax team with respect to these standards, because a private company is afforded a lot more flexibility typically than public companies will be afforded. So they need to make sure that certain restricted services like tax provision preparation, FIN 48, ASC 740-10 preparation review, SOX internal controls review, those types of restricted services are in fact being prepared by an independent third-party tax provider and that are completely independent of their audit firm. It's really important that you have that demarcation between your audit firm and your other restricted services to make sure that independence is preserved. It's just as important to make sure that your current tax team is in fact going to be proficient once your company actually goes public, because there are going to be so many different complexities and demands on your tax function, your tax team, that you need to make certain that if you're operating with a lean and mean tax function right now, that in fact it is proficient and adequate enough to handle all of the additional work and the additional complexities that come with becoming a public company. So again, the very first step in the process is to step back, evaluate your tax team in terms of independence and in terms of proficiency. The second step is to evaluate your internal controls. SOX 404 was not mandated for private companies, but many private companies instituted internal controls as a best practices sort of a measure. So if you don't have internal controls, this is the time to start early implementing those in terms of becoming a public company. And then even if you do have internal controls, you really need to sit down and review those internal controls to make sure that they're adequate to meet the needs of a public company, because it may be that you need to bolster those internal controls or refine those internal controls in order to make them adequate for public status and to meet all SOX 404 requirements. So that's the second step in the process. The third step in the process is perhaps one of the most important, and that's really to implement and practice a quarterly close process. When you're a private company, you have a lot of flexibility with respect to tax provision preparation timing, as well as financial statements timing in terms of when they need to be issued. When you're a public company, all that flexibility goes out the window and you are tied to specific deadlines, specific SEC imposed deadlines. And now no longer are you just having to prepare one tax provision and really 1 year's worth of financial statements, one annual financial statement. Then if you're a public company, you've now got to prepare 4 tax provisions and issue, 4 sets of financial statements. So again, there's a big discrepancy, big change between going from private company to public company status. And then not only is there more work in terms of having these 4 filing requirements in terms of your financial statements as well as your tax provision preparation, but also everything's accelerated now because of these very specific SEC imposed deadlines, to which you had a lot more flexibility on the private side. you no longer really have that flexibility on the public side. So in order to get comfortable with that accelerated time frame and with that additional work, it's very important to at least a year in advance really practice, implement and practice that quarterly close process to get it down pat so that you aren't taken unawares or by surprise when in fact you're a public company and all of a sudden all of these requirements start rushing towards you. You will have practiced all of these requirements well in advance and have them down pat. So that's step 3 in the process. Step 4 in the process will really help you in terms of meeting all these deadlines. And step 4 is really to create and make sure that you've got a core effective tax provision model. And if you're familiar with Clifton Douglas's videos, we have a video that's specifically on this particular topic in terms of how do you create an effective tax provision model. And it goes into great detail in terms of what an effective tax provision model includes. So I would highly recommend that you review that video to get a very good idea as to whether or not your current tax provision meets those standards and what you can do to, of course, bolster your current tax provision. And this is really important, again, from the standpoint of because you have these accelerated time frames when you go public, you're not going to have as much time to put together the provision or to review the provision. So from that standpoint, the provision itself needs to be as effective and perfect as possible so that, again, you can have accelerated review times that lead to smoother audits, that lead to more easily meeting these deadlines and these time frames that are instituted by being a public company. So again, an effective core tax provision model is really at the heart of meeting these accelerated deadlines and meeting these quarterly close processes. So that's step 4. Step 5 is really addressing IPO-specific issues. And IPO-specific issues run the gamut. I mean, this is a really complex area, a lot of things going on, but there are 4 areas that we see pop up continually. The first one of those is really 382, 383 tax attribute limitations. Primarily from the standpoint that when you're dealing with an IPO, you're typically dealing with a lot of ownership changes, and those ownership changes may come to the level in which case they exceed 50%, which results in a change of control. Well, a change of control can therefore lead to basically 382, 383 limitations on your tax attributes. So from that instance, you really need to look at 382 and 383, and those analyses can be very in-depth, very time-consuming to do. So it's important to do those, up front and really understand whether or not, you have limitations on your tax attributes and how, in fact, those limitations are going to impact your taxable income as a public company. Also, with respect to valuation allowance issues, typically when a company goes public, they'll use some of their proceeds to pay down their debt, and that reduction in debt thereby reduces their deductions. And when you reduce those deductions, your taxable income is going to go up. And when your taxable income goes up, it basically creates the opportunity for companies to use their tax attributes, to use their deferred tax assets. Well, oftentimes companies have valuation allowance against, or oftentimes private companies have valuation allowance against their deferred tax assets because there's a question as to whether or not they're actually going to be realized or utilized for all purposes. And so from that standpoint, when this additional taxable income becomes available, now all of a sudden maybe you are going to utilize these deferred tax assets. And so the question becomes whether or not you should actually have a valuation allowance against that DTA, or whether or not you should release it in full or in a partial amount. But that consideration, that valuation allowance consideration, is a huge analysis, a huge undertaking that involves the audit team, it involves the tax service provider, the company itself, obviously company management, to really look at the positive and negative evidence to determine whether or not that valuation allowance needs to stay or be released in some part or in full. But that's a huge undertaking. It needs to be started early. Also, again, issues surrounding stock when you're dealing with an IPO, cheap stock, Section 409A is a big issue that comes up, and it really relates to fluctuations in the fair market value of stock, both pre-IPO, and then upon IPO. And this can lead to various accounting related issues as well as, tax related issues. So from that standpoint, really your share prices and all of the values that are assigned with respect to going IPO really need to be evaluated to understand what those accounting and tax implications are going to be. Also, tax-related law that's very specific to public companies as opposed to private companies needs to be evaluated. For example, Section 162M related to non-performance-based executive compensation. In that particular instance for public companies, you have an annual limit per executive of $1 million in terms of a compensation deduction per year per executive. But private companies aren't subject to that same rule. So when a private company goes public, all of a sudden their deductions related to that might be limited. And so it behooves a company to early on understand what the impact is of losing that particular deduction. So again, those are just 4 IPO specific areas that we see pop up pretty on a regular basis, but the IPO issues can run the gamut. So again, really important to start the process early and really understand what the implications are, the tax implications from an IPO. Let's see, the 6th item is really to implement ETR reduction strategies. When you're a private company, you're really interested primarily in cash savings. The effective tax rate is not necessarily a main focus, just from the standpoint that you don't necessarily have all these investors looking at your ETR and the SEC looking at your ETR. When you become public, then you do. The street is all over you in terms of your ETR. The SEC, wants to understand, your ETR. Your effective tax rate becomes very important when you become a public company. So from that standpoint, a lot of companies that are looking to go IPO want to implement ETR reduction strategies. And it's a great idea, but they really need to be started early from the standpoint that most ETR reduction strategies need to be implemented early to enjoy the benefits, because it takes a while for those benefits to in fact result. So again, starting these ETR reduction strategies early on in the IPO process is going to create a situation where once the company goes IPO, they can actually enjoy those benefits of the strategies that were implemented. So again, really important to implement those ETR strategies early on in the process. Now, the final step in the overall process is to really align the footnote of the private company with the public company. And now there are various aspects of public company footnotes that private companies don't have to disclose. Many of them do disclose this information just as a matter of course, but again, it's at a good time before you go IPO to make sure that in fact you have this alignment. One of the major areas really relates to ASC 740-10, previously FIN 48, with respect to a tabular reconciliation of the unrecognized tax benefit. And for public companies, you have to disclose this tabular reconciliation, which is really just your beginning UTB, or your unrecognized tax benefit balance, and then additions, subtractions, basically the activity during the year, and then of course your ending UTB balance at the end of the period. But private companies didn't have to disclose that. So now if you're going to become public, you've got to make sure that that tabular reconciliation shows up in your footnote. Also, you need to disclose whether, if in fact these unrecognized tax benefits were to be recognized, would they impact your rate? And so from that perspective, public companies have always had to disclose that, or have had to disclose that since FIN 48 was around. Private companies have not had to. So from that standpoint, you need to make sure that your footnote does disclose that language as well, if it doesn't already. So again, going public is an exciting time. Going IPO, I mean, just a huge really transition for a company, and just an exciting time. But it definitely, to ensure a successful IPO, it makes a lot of sense to really look at your overall tax function and to really prepare for that transition, because going from a private company to a public company just involves so many additional complexities, so many additional nuances that again can easily be taken care of if there is enough time allotted to prepare and to practice actually acting as though you were a public company and implementing all of these additional requirements that public companies have to adhere to. So again, practicing that 7-step process that we just went over in terms of, again, stepping back, looking at your current tax team, making sure that, it's basically independent and proficient. Also looking at your internal controls. If you don't have them, creating them. If you have them, refining them, bolstering them. Practicing a quarterly close process, extremely important. Perfecting the core tax provision model, extremely important. Dealing with IPO specific issues, implementing ETR reduction strategies, as well as finally aligning that your tax footnote with public companies. Doing all of that a year in advance of actually going IPO is just going to make you that much more prepared when you actually do go public. It's going to go a long ways. So again, if you'd like to learn more about how Clifton Douglas can assist in terms of helping your company transition from private company to public status in terms of their tax function and in terms of tax considerations, you can certainly review our article in the Journal of Accountancy's October 2011 edition entitled Act Public Before Going Public, or certainly visit us online at cliftondouglas.com or just give us a call. Thanks so much for watching today, and good luck with all of your IPO transitions, and thank you so much. Have a great day. Bye-bye.